what I'm going to show you is we are going to start with the most important chart in the markets right now. In my opinion, this is something I don't think anyone's really talking about. Very few are. Everyone's focused on tariffs and trade deals, which do matter. But what really matters right now is what's going on in the bond market. This is TLT. It is long duration U.S. government bonds. It is the best measurement for growth and inflation expectations. You don't really want to own a fixed yield when growth and inflation is going higher. It just doesn't make sense. You want to be in something that's going to participate as opposed to a fixed yield, which will lose purchasing power as growth and inflation goes higher. And you do want to own a fixed yield when growth and inflation is going lower, right? When you're in a disinflationary or deflationary environment where prices are going down, that fixed yield is very, very attractive. And that's kind of created this inverse correlation between bonds and stocks that we're so familiar with. And to kind of show you, I think it's important to see the history of this because it hasn't always been that way. Everyone assumes it is that way, but it hasn't always been this way. What you're seeing is the 30-year yield on the 30-year government bond. I don't have a chart that goes back for bonds this far. I just have the yield. So as we all know that when bonds go higher, yields go lower. There's an inverse correlation. So to show you what bonds did, I'm going to just invert the chart. So now you're looking at what the 30-year bond did, roughly speaking. So this is 1987. And whenever stocks cratered, keep in mind growth was decelerating in that time frame too, bonds went down. In 1989 to 1990, a pretty nasty recession. Stocks went down, bonds went down. Same here in 1994, we had a drop, growth scare, 94 bonds went down with stocks. And so you can, and it goes back as far as the 70s, the 60s, there was basically the correlation we are so familiar with was the opposite. And then something happened in 1998. Stocks went down, bonds went up. All right. The correlation that was, been around for decades broke. And it's been that way ever since. As stocks go down, bonds go up. Stocks go down, bonds go up. Stocks go down, bonds go up. Right? It's so uniform. It's like an axiom of investing that the 60-40 portfolio was based off of this correlation. That when stocks go down, bonds go up. That started in 1998. So what changed? Prior to this, we were in this inflationary super cycle. Okay? World War II spending, the Great Society, Vietnam spending, getting off the gold standard. All these things led to some pretty inflationary environments. And even though stocks were going down and prices were going down, inflation was still high enough to where bonds weren't very attractive. They still weren't very attractive, even in those environments. However, in 1998, what shifted was a kind of a culmination of a few things. Technology expanded. Personal computing came on board, it started becoming more affordable. Globalization happened, which was very deflationary, and baby boomers, which were a big part of the growth of the population story, they kind of hit their peak spending years in the 80s and 90s, and now started kind of, their spending went down from a demographic standpoint. And then when you factor in that Paul Volcker in the 80s raised interest rates sky high, the Fed had a lot of room to kind of combat prices. So all those forces together created a kind of a super cycle deflationary environment, which is why we saw this correlation between stocks and bonds hold for so long. And then something happened in 2021. Stocks went down and bonds went down even more. And now we were told that it was a one-off instance that the COVID shutdown disrupted the supply chain, which caused this artificial inflationary environment. And it's going to go back to normal, nothing to really get worked up over. And we're seeing it in the CPI numbers, this kind of deceleration in the headline CPI numbers, proving that narrative to be true. However, if that were the case, stocks going down 20%, growth scares coming up. We're seeing recession odds up in the 40 to 60 percentile for this year next. We're seeing earnings forward guidance getting pulled. Not a good sign. We're seeing the ones that aren't pulling forward guidance lowering their guidance. We're seeing a struggling consumer. We're seeing growth slowing down and stocks hitting a technical bear market and bonds don't care. They're not going higher as they have been in the past. Even during technical bear markets and corrections, we will see that correlation. I mean, this is a correction here. This is a minor correction in 2015 and 16 compared to what we saw, and bonds still skyrocketed. So we're not seeing that happening. So it begs the question, what's going on, right? We just had excellent CPI and PPI numbers in terms of inflation going down below expectations. That should be a boost for long dated bonds, but they're not catching a bid. They're no bid. They're catching a no bid situation. No one's buying. So are we seeing a transition right in front of our eyes back into a more secular inflationary environment? It's a big question. If that's the case, it's not going to be good in the transitional period. Just like in, the 2000 to 2002 bull bear market, that a lot of that was due to this kind of secular, global economic transition from an inflationary to a deflationary environment. So that would be a big deal if that happens. What's more important on the immediate term is the fact that the U.S. debt to GDP, which is this says 122%, but estimates have us crossing the 130% level. Now, what this means is that if you're going to service your debt, you're paying the yield on an annual basis, right? So you just got to pay the yield to keep the debt going and not default. You should be doing that with just the GDP. And so this is what you use to pay this. And the higher this goes, the higher this has to go to service this, or the more pressure it's going to put on this. Okay. And whenever your debt's growing exponentially larger than your GDP, at some point they make a separation, and that you're going to need to borrow money just to service your debt. When that happens, historically, we tend to see the bond market say one of two things. I don't want to buy your bonds because at this rate, you're going to either default on your debt, which we don't want to own your bonds if that happens, or you're going to print money and inflate your way out of this. In that case, we also don't want to own bonds, long-dated bonds, because your inflation rate will have to go up so that to match all the money you're going to create just to service this debt. And so that's what I think is going on right now. I think this is also why the tariff wars were pulled back on. I think they were expecting bonds to go higher, which would allow them to service the gargantuan amount of debt that's due this year. I think there's $8 trillion that has to be refinanced this year, $5 trillion next year. And keep in mind, the lower bonds go, the lower yields are, which means the more it's going to cost to service that debt. So that's a problem, right? If we see TLT break down, I would expect to see the Fed step in and do emergency QE. If that doesn't work, expect them to do yield curve control. There will be big guns shot. The initial scare will probably not be good for risk assets, but once it settles in, it will be good for risk assets for a time period. It'll also be a really fantastic story for gold and Bitcoin. So this is what we're looking at right now. This is the big story. The other thing that matters, and I talk about DXY a lot, the dollar index. This is basically the US dollar compared to other major currencies. So as the dollar goes higher, it's going higher against, say, the euro and the Japanese yen, right? It usually is an indication of money flowing into the US economy, okay? Since this top here in January 2025, we've been in a 5-wave drop, just, money flowing out of the US. And it looks like it's going to 95, so it has one more drop to make. Now, why does this matter? What you're looking at here is domestic liquidity, which is basically, think of it as the possibility, the amount of money in the system that will allow for lending to happen. I think that's I don't know how I can explain that. That's a very general, rudimentary way of understanding. It's just the amount of money that is able to be used to lend within the economy. Okay. And so historically, this is our debt right here in the red. Historically, the liquidity of the US is higher than its debt. That's not the case, right? Our liquidity is not enough. If all the liquidity in the US was used to buy debt, it wouldn't be enough. And we've kind of reached this point where there's been a separation, which means that we need foreign investors to buy our debt if we're going to see this refinancing happen. So the lower DXY goes, the less money is going into the US, the more is being pulled out. That's not good, right? This would mean that the higher yields will go on the TLT. So the dynamics right now are not good for what needs to happen, this refinancing that has to happen with our debt. And so this to me is the biggest story to be looking out for. Okay. When it comes to, there's two counts that I'm tracking on the S&P 500. This right here is going to be my primary, my new primary. We're in an ending diagonal, a series of 3 waves up, 3 waves down, 3 waves up, 3 waves down. The final move will be 3 waves. Okay. So I'll get into why I'm switching my count. It's still a coin toss to me, but just for risk management purposes, this is kind of what we're looking at. So what we saw was a 4th wave, a very sharp one. We have an A wave up. We should get a B wave and then a final C wave to 63.65. The other scenario is, this has kind of been my original count for a long time. Another diagonal pattern right there. We have 1, 2, 3, 4, 5, right? This was the end. 3 waves down, 3 waves up. Then we get a C wave that will take you down to 46, 45, 4400. Okay. Now, nothing has changed in my analysis. Is the next pullback will be the tell. Both counts were requiring a 3-wave move off the low. That's what we got. We have a 100% 3-wave move. But the next pullback needs to be 3 waves back, and then we take off. The 3-wave move retrace that makes a higher low is bullish. That's confirming that this is in play. If we get a 5-wave move, a direct 5-wave move, then the odds favor this scenario playing out. Why I'm pivoting is because B waves, they follow rules and guidelines. This isn't a rule, this is more of a guideline. Typically, the B wave will retrace to the 50% to 76.4% retrace of the entire A wave. These are Fibonacci numbers. Why does the market do this? I don't know. It just does. These formulas and patterns are all over the place, but they're very effective. And so what happened was at 58.36 is the 76.4 retrace was also a Fibonacci confluence zone and also a Gann square of 9 level. It's basically Gann's method for identifying the horizontal important levels. So we had 2 techniques saying that this level is important. It's also the 200-day moving average, which was right here at 57.53. We gapped above this level and we've closed above it multiple days. Okay, you can't ignore that, which has me open to the idea that this is in play, that we get an A, B, and a C. And so I just want everyone here to, like us, not be married to one scenario or the other. It's really important to stay objective. And when you start getting clues like this, you got to be ready to pivot if the market gives you that opportunity. Okay? So other reasons why that I'm kind of leaning more bullish right now is I'm being forced to change counts, like IWM, for example. We were tracking this, 2021 top, there's your A wave, overlapping mess for B that makes a double top, and then a clear 5-wave drop right here. The best count for me is a 1, 2, 3, 4, 5, but this move went too high to be a 4th wave, which means I had to change my count to either this being a very shallow C wave, and now we get A up, B, and then C that makes a lower high, or we're in some kind of exaggerated 4th wave right here that holds this trend line and then turns lower. Either way, I don't like it when I have to kind of change an obvious pattern to something a little bit more muddled.